What Karen needs to do today to save well over $100,000 of income taxes in the future. In fact, to be honest, to be exact, $114,139 in taxes. She will pay more if she doesn't start taking action today. So welcome to Heritage Wealth Planning YouTube channel, my friends, the place you come to learn all about income tax saving, because this gets me fired up. If it doesn't get you fired up, I don't know what to say, but it does me. So don't forget to subscribe down below, share the videos, the whole thing. All right, so I had a lady on YouTube, one of my videos posted, Karen. I presume she's married. She says she makes about $47,000 in Social Security, has a $150,000 IRA, has a pension of $13,300. And so her question is, what should she be doing? And that's all I know about it. So that's it. I don't know anything about it other than she's 67 years old, that amount of Social Security, that amount of pension, that amount of IRA. So I said, let's just do some Right Capital software program and see where it takes us. It'll be pretty interesting. So what we're going to do is we're going to go to profile, and I just use Karen and Ken. Probably was it the lady Ken and Barb? Yeah, Ken and Barbie. But anyway, I use Karen and Ken, saying she's got $150,000 in an IRA, which is what she said. I don't know Karen from Adam. She just posted on YouTube. I thought it'd be of interest. And I'm saying she has a Vanguard Life Strategy Growth Fund, $150,000 in her IRA. All right. I'm saying they retired. They're already retired. So they retired at 65. Now they're both 67, both Karen and Ken. They're going to spend $3,500 a month in retirement. This does not matter. The income, the expenses, it doesn't matter. The only things that matters from a tax perspective is how much they got coming in. That's all that matters. The IRS will tax you on how much you have coming in. They don't care for where it goes. They don't care if they use it to put food on the table, to pay your health insurance bills, or to sniff it up the nose. They don't care. They just care about where it's coming in. And so this right here is completely irrelevant. But I had to put something. Well, I didn't have to. I just felt like putting something in there to, I guess, keep it honest. That's all we're spending. Again, don't say, they're not spending anything in healthcare. It's not a financial plan. It's a tax plan. It does not matter that they're not spending anything in retirement other than just a simple $3,500 a month plus about $4,000 a year in property tax. And that even doesn't matter. All right, so their income is going to consist of three sources. All right, we got Karen's Social Security at 60 is $2,500 at her full retirement age. All right, so $2,500, and I just said Ken is at $1,381 because Karen had given me a specific number of their dual Social Security. I think it's right about $47,000 a year, roughly. Karen's got a pension at $13,300. Now I am saying it's a 100% survivor benefit. And I am saying it's a custom cost of living increase of 3% a year. I don't know that to be true, but I'm just saying that. All right. So now what we're going to do here is we're not going to annualize. We're going to do Roth conversions in the future. Right now, we're not going to do any Roth conversions to show you what happens here. Right. So that's it. They're not having any savings. Doesn't matter their expenses and their family. Again, Karen is 67. Ken's 67. We're going to have Ken dying at 90 initially. And we're going to have Karen dying at 90 initially as well. All right. So basically just a simple just a simple tax plan. And so if we go here to taxes, what it's going to show us now is you'll see there's estimated effective tax rate. And the first couple of years is nothing. They got nothing. Look at that. Until they're 69 years old, they don't pay any taxes next year, this year, or the following year. Then they pay a little bit with RMDs, required distributions, and they pay more and more. And as their RMDs kick in, they start getting more. And now the state tax kicks in. And now they're 80, 90 years old, and they're paying, what's that, about a little bit more than 15% when all said and done for state and federal taxation. All right. So if we go to the details of this, we can see the first year. This is the 1040 we'll show you. They got nothing from W-2, not making any money. They got a pension of $13,300. They have Social Security benefits of $50,300 roughly, of which only $3,000 is taxable. So not much in terms of taxable income at all. In fact, in terms of AGI at all. So you take your $13,300 plus your $3,000 Social Security that's taxable. It gives you taxable income of $16,000. That's it. Their standard deduction is $27,000, so they have no taxes whatsoever. Fast forward a couple of years, we'll say 2025, when the required distributions kick in. They got $23,641 of pension and RMDs. They have $57,000 of Social Security, of which only $14,000 is taxable. So it gives them total taxable income of adjusted gross income of $41,000. of which you take your standard deduction. At that case will be $30,000 because today in 2019 is $27,000. You adjust it for inflation. The tax brackets are also adjusted for inflation on the Right Capital software as well. So 41,126 is their AGI. Subtract your standard deduction. Their taxable income in 2025 is all of $10,578. No big deal at all. And they pay $870 to Uncle Sam and nothing to the feds. All right, so pretty good, right? Fast forward, and just real quick, the reason they have a little bit of taxable interest in ordinary dividends and long-term and qualified dividends is simply due to the fact that they're reinvesting their net flows. So they're not spending enough in terms of what's coming in. They're reinvesting it in taxable accounts, which is paying off dividends and capital gains and interest, but it's not taxable at all because, again, qualified dividends and capital gains are not taxable when it comes to if you're in the 12% tax bracket, which they are. So that's not taxable. Just the taxable taxes are very, very minimal. So we'll fast forward to 2000 and let's say 40. Now it starts getting a little bit more burdensome. Social Security benefits at that stage are $82,000, of which that's 75% are taxable. They have pensions and IRA mandatory distributions of about $43,000. Add all that stuff up, their AGI is 142. Now we're back to we're back to standard deductions and personal exemptions. They haven't changed over the Right Capital software to revert back to pre-Trump tax bill. So this line 9 says qualified business income is actually it's personal exemptions. They haven't changed that. They will, no big deal. So we're taking out our personal exemptions, our standard deduction, our taxable income here is $103,000. Puts them in the 22%. It's probably 12% bracket at that stage still because of inflation. $13,000 to Uncle Sam and some to the state of California as well. So you can see how that shakes out. And again, if we go to this guy right here, you can see that it just grows and grows and grows. I mean, not anything extraordinary, 10% or so, and then basically 15% in the latter part of their lives. Now, watch what happens though when we kill off old Ken. All right, this is where it gets I'm telling you, man, this is the widow's tax trap that everyone just poo-poos. I really wish they would not. So we're going to kill off Ken. We're going to say he dies at 80 years old and watch the difference. It's nuts. All right, so now Ken's dead at 80. All right, so now watch what happens from the tax perspective. Kaboom, right there. It goes from 5.3 to the feds and 1.2 to the state to look at that, 11.1 to the feds and 2.7 to the state. And that's simply because there is no joint married filing jointly. All right. So let's look at, that's the widow's tax trap. It's literally that in a nutshell right there. So let me show you what I'm talking about. We go to cash flows. So we got Ken dying at 80. So if we go down here, well, they're 80 years old. So right here, they make $86,000 a year in income. Let me move my mug out of the way. All right. So $86,000 in income, $12,000 in IRA mandatory distributions. Their total income at that point is $99,288. They got expenses, and again, it does not matter, and they got tax payments of $5,000. All right, so you with me so far? $5,000 of taxes on $100,000 of income. Now let's watch the following year. Their income drops to $64,000, or basically 25% of their income is reduced. So they have $64,000 of income inflows plus $13,000 of mandatory distributions. It'll be Karen because Ken's no longer with us. So the RMD stay the same, and their income total inflows flow from $99,000 to $77,000, basically a 25% decline in income. And it doesn't matter about their expenses. Again, in this stage for the tax planning, it does not matter. But their taxes went from $4,998 to $11,000. So basically 25% decline in income, and yet a 150% roughly, about 125% increase in taxes. I mean, you can see it right there in front of your very eyes. Look at that. 125% in taxes on a 25% decrease in income solely because Karen is no longer married filing jointly. She's a single taxpayer. Now, if we scroll on down, it gets worse. And let's see what we got here. Total inflows. So let's go down to 2037. All right, we'll just go to 2037 on the tax report and see what we're looking at. Because I don't know what the 1040 looks like. But remember, once we start breaking, and today's number is about $75,000, we're going to have taxes on our Medicare premiums as well. increase in, let's say 2040, let's say 2040. We'll have increase in Medicare premiums on top of increase in Social Security tax, on top of increase on capital gains and dividends, on top of higher tax brackets. So here, 85% of our Social Security is taxable. We have Social Security benefits of $53,000, of which $45,000 is taxable. 85% is taxable. We have RMDs and pensions of $43,000, and this is 2040. So we have at this stage, 122 is our AGI, and everything that we have is in terms of Medicare premiums is based on AGI. So 122, most likely, we don't know what's going to be at that point in 20 years from now, but as we sit here today, this would increase her Medicare premiums on top of everything else that she has to pay. So not only does she have to pay more in taxes, but she's going to have to pay significantly more Medicare premiums as well. All right, so I can't make it any clearer of what it looks like in terms of the tax bomb that awaits for you. And if only someone did a book on the tax bomb in your retirement account. Oh, your old buddy Josh did. Go to Amazon, type in my last name, Scanlon, right there, and you will find that book for your reading pleasure for sure. And look at that jump, man. I mean, it goes from 5.3 to 11% in taxes. That's just, there you go. So, all right, the next video, what we're going to do is we're going to show you what happens when she does a simple Roth, she and Ken, when they start doing Roth conversions on the front end. Now, what's going to happen is you'll start seeing a little bit more on this side, right, because they're paying a little bit more taxes, but they'll see a whole lot less on that side. So remember, 13% is what they're paying in the feds, and 3.2% is what she's paying in the feds when she's 89. Watch what happens when we start doing Roth conversions. And then I'm going to show you my spreadsheet where you can see, we're going to show you the difference in taxes from dying both at 90, dying at 8. Ken dies at 80, Karen dies at 90. Roth conversions, and the Roth conversions of Ken dies at 80 as well. You're going to be stunned. You'll be stunned. So stay tuned. Subscribe down below. As always, if you find value here and you want to support the program, watching it first and foremost helps you the most. And sharing the video, thumbs up, and commenting are big help. But if you want to donate, go to heritagewealthplanning.com. On the bottom of every single website there, it'll say donate, and I'll be happy to receive your donation. It'll be much obliged. We'll see you guys next time. Stay tuned for the next video where I show you part 2. All right, thanks now.